Hi, property investors. It's Nick Garner here from InvestMore. Today, we're going to have a brief look at real estate capital growth. We're going to look at what this actually means, how to understand it, and I'll show you some maps we've created with capital growth data to help you understand where you're going to find good capital growth. Capital growth is the growth in value of property over time. You can look at capital growth in nominal terms, and that means that you're not actually adjusting for inflation. Or you can look at capital growth in real terms, which is inflation adjusted. To understand capital growth, it's important to understand the concept of purchasing power. So, for example, if you bought £100 worth of groceries 15 years ago and you bought the same groceries today, it would cost you £146 because that's the amount of inflation we've had in the last 15 years in the UK. If you bought a property for £100,000 in 2007 and you sold the same property today for £100,000, you would have lost around 33% of the true value of that property. In other words, that £100,000 in your hand today will buy about 33% less goods and services than it would have done back in 2007. Another important concept is property affordability, and this is the ratio of property price by income. If a property is £150,000 and someone's income is £30,000, the affordability ratio is 5. 2007 had the highest affordability ratios in modern history. The last time affordability was this bad was 1893. When we look at different areas, we use the 2007 affordability ratio as our high watermark, as a reference for long-term economic growth and house price inflation in a given area. If you compare two cities, for example, Manchester and Liverpool, Manchester is an economically successful city. Economically productive people who can afford to pay higher prices for property have chosen to live there. But if you look at Liverpool, it's not such a good story. The city has been less successful economically, and people who live there can't afford to bid up the price of property so that property values have actually gone down in real terms. For example, if you had bought a property in 2007 in Liverpool L1, it would be worth about 66% of its original value in real terms. If you'd bought another property in Manchester M11 in 2007, it would be worth 119% of its original value, or in other words, it would have gone up in real terms by 19%. Capital growth occurs in patches, and within those patches, there are small areas you should avoid. There might be, these areas might be dominated by high crime or social housing or other factors that put people off buying in those locations. So what we're going to do now, with all of that in mind, is have a look at some of the maps. And from there, you'll get an idea of where the capital growth is and where you could potentially invest. So let's get into it. Let's start off with benchmarking. The first benchmark that I always use when analyzing an area is property prices in 2007. And that's for a few reasons. One is that 15 years has gone by and you've got enough time to look at the strength of an overall economy in a given area. It's also when property was at an all-time high, or at least in modern history, all-time high affordability ratio. In other words, it's the multiple of your income against property prices. The last time property was this expensive relative to earnings was back in around 1890. And so this is just 2007 is a really momentous moment in recent property history. The other time where affordability was very stretched, of course, was in the post-war years, and we're starting to see these 2007 highs being pushed again in over the last year or so. Here we've got a map showing the inflation adjusted or the real property prices from 2007 to date. And what it shows you is that some areas like London, which is red, i.e., hot is red and cool is green, you can see how some areas have done really, really well over the last 15 years, and most areas haven't. So if you see that most of the country is in fact green, but what you also notice is how you get these massive concentrations of house price growth, and then you get a radiating effect, almost like a stone being thrown into a pond. It just kind of the effect radiates outwards into the whole of the southeast. Whereas in the north, for example, you can see that there's really been there are really very, very few areas apart from, say, small patches of surrounding cities, but the real hot area would be Manchester. And here, for example, in London, if you had bought in the right street or the right area and you'd bought the right property, then in real terms, let's say you bought for £1 million and you inflation adjust that for purchasing power, in real terms, your wealth would have gone up 50%, or the true value of the property would have gone up 50%, which is a huge amount. But if you zoom out and you look at places like Blackpool, which is another extreme, if you had bought a property in Blackpool in 2007, in real terms, it would have declined by 50%, which is astonishing. That's the long term picture. And so, based on correlations I've seen, what I what I've concluded is that long-term capital growth really does correlate very heavily with long-term economic strength of an area. In other words, people are able to bid up the price of property because they can afford to do it. If they can afford that, it's because they're confident and or economically confident, let's say, and they've probably got good jobs and are secure, economically secure people. And that sounds like a good tenant to have if you're a buy to let investor, for example. One of the other things you're going to notice about capital growth is how patchy it is. You get areas like this, for example, where there's either no real growth, or you get areas like this, and they kind of coexist together. So growth doesn't happen everywhere. In fact, it's relatively localized. But what you can say is that if you have a general area where there is capital growth, the rule of thumb is to avoid patches within these good areas that are undesirable. So, for example, you might have a whole area. Now, this is our demographics information, so we're kind of going beyond the basics of capital growth. But, and I'll do a video to explain exactly what you're looking at in the future. But just to say that there are certain patches where perhaps you've got a lot of social housing, you might have a lot of crime. So, for example, here's a good example of an area that has a lot of social housing. So here we've got a high proportion of people who are social grade DE, in other words, casual workers or unemployed, and you've got something like 2/3 of the property stock in this area, which is socially rented. Then you've got a compounding problem, which is that you've got a lot of crime in this area here, which means that this little patch is probably a very unwise place to buy in because it's just it's got the kind of crime where you get people being harassed and whatever. And those and good tenants will not want to live in bad areas like this, and that makes this a bad investment. So going back out, zooming back out to capital growth, you can see, in fact, that this little patch here hasn't seen such good growth in the long term, whereas this has. And that's ultimately because of demographics. Therefore, when you're analyzing property, it's really important to look at the who, i.e., who is behind who lives in the area and who would want to buy this property. And from a high level point of view, you can look at mapping like this, and if you're one of our clients, that is, and you can then kind of get a sense of which patches are more likely to do well in the long term. Let's look at the short term capital growth now. I'm going to hide that layer and I'm going to just zoom it up to 1 year growth. And what you see here is that there are certain little patches which are very, very hot right now. To give you some context for long and short term growth, we'll just put both layers up. And in the short term, this patch, which is Stockport, I think, yes, is Stockport. This has been doing great. Longer term, it's been kind of neutral. Would I buy there? And I think based on general longer term growth being above inflation, short term growth being good, I would say that there is probably some headroom for continued growth over time. And a patch like this would interest me a lot. That's an example of evaluating short term over long term. I'll show you another example, which is Blackpool, which we looked at earlier. Long term, it's very poor, and short term, it's been aggressive. Would I buy in Blackpool? No, I wouldn't, because I just don't have confidence about the long term economy in that particular city. If we look at Liverpool, Liverpool is known as a hospitality city, so its economy has been very badly damaged due to COVID. And in the long term, if you look at the smaller green boxes there, just capital growth has been very, very poor. And in the short term, it's also been very poor. Would I buy in Liverpool? I don't think I would. So when you're looking at capital growth, it's very important to look at the long-term picture, i.e. whether the economy is strong, the short-term picture, i.e. is there a lot of heat locally in the market? And if you can find areas where long-term growth has been at least in line with inflation and maybe the short-term growth is buoyant, then that's a very positive sign. Beyond that, then you look further down and you look at demographics and you look at the kind of people that want to live in that area. And if the property price is right, the yields make sense, and you're confident you can attract the right kind of tenant that's going to pay their bills every month, and that the property is growing in true market value, then you're going to get good income from rent. Obviously, after tax, it'll be a reasonable income. And assuming you've borrowed up to say 65% loan to value, or maybe a little bit higher, beyond getting a positive cash return on your yield, you're also going to see a growth in real terms, which means that you could refinance after a few years. And typically, you'll see that the money you can extract from refinancing will be probably twice that from your rental income, which is remarkable, in fact. If you please like, and if you want to see more of this, please subscribe. And in the meantime, invest well.